Okay, we'll get started. And as people come in, they can catch up a bit. Again, my name is Anthony Morena from Mortar Group. This is the first of the Mortar Wealth Strategies webinars. Where we're going to try to pick up on certain topics on occasion and kind of walk through the details as best we can. Today, we're going to get into SDIRAs, tax-free growth with the self-directed IRA, something that's becoming a bit more popular in recent years. So I figure it's a good topic to go over in some detail, just because we get a lot of questions about it. And yeah, we can kind of dig right into it. And at the end, if anyone has any questions, happy to kind of walk through anything. And then there'll be a copy of this webinar that'll also be available. Before we get started, just general disclosures. Always consult with your tax advisor, attorney, with any investment, and especially with tax advice. Before we get into the topic at hand, just to kind of give you a little background about myself and Mortar Group. So we are a New York-based real estate firm. We work in New York City, Manhattan, Brooklyn, Queens, multifamily real estate. For at this point, we're nearing 25 years, started in 2001. We work on syndications and small portfolio investments of value add and ground up construction throughout New York City. At this point, we've completed over 35 projects, and we're hoping to close in on 40 by the end of 2025, and about a 306 million in gross sales over that time. Just a quick look at some of the recent work that we do. Like I was saying, we do a mix of ground up construction and your more traditional value add work. We'll see some case studies and how it applies to a self-directed IRA later, just to kind of give you a general snapshot of what we do and what we've been up to. Our goal is to, try to do things a little bit differently. We're a boutique firm in New York City. We are not a larger institutional fund. So we tend to work with individual investors and get to know every one of our investors fairly well over the years. Our first project started with friends and family and then kind of grew from project one with a few people to 10 people to 20. And now, we're quickly approaching 500 investors that we work with on a variety of our deals. We're focused in New York City, like I was saying, sub-institutional, multi-cap, mid-cap, multifamily real estate, predominantly multifamily. Properties, range from 5 to 40 units with valuations of 5 to 6 million to 40 million per deal. And we kind of work in the neighborhoods that we know and we're familiar with. Manhattan and New York in general I grew up here, so I know it like the back of my hand. I know the fluctuations that happen from block to block, and how pricing is adjusted in these kind of dense urban areas. So I think it's an expertise that we have really come to focus on and use to our advantage. We work on a syndicated fund hybrid model where we acquire small portfolios in the New York City area to target efficiencies and maximize returns in our market while providing investors good returns at a lower cost of construction and overall development than your traditional larger private equity firms. We're a vertically integrated shop. My background before getting into development is architecture. I'm a licensed architect, and very early in my career shifted over into development with the idea of integrating architecture, construction, and investment management and all into one. That's what Mortar started as in the more preliminary level, and then it's kind of grown into the shop that it is today. So we kind of do a lot of stuff in-house, manage inefficiencies, manage costs well throughout the projects that we do. And we tend to kind of focus, like I was saying, in New York City and just managing that expertise over the years. All right, so getting right into it and self-directed IRAs. Like I was saying, this is a topic that has become more and more popular over recent years. I think the first self-directed IRA that we saw an investor come in with maybe 5-6 years ago, and then it's slowly gotten more and more interesting, where more people are bringing it in, talking about it, bringing it up. it's 3-4x every year the number of investors that kind of come in using this kind of investment or a strategy. So I figure it's a good topic, and we'll jump right into it. First, before looking at SDRAs, with any investment that you do, I think one of the topics that comes up with investors. So, like I was saying, we don't work traditionally with institutional investors or family offices. We work with individuals, and each individual that you work with and you come to know over the years, everyone has their own approach to investments and their overall strategies. Whether it's capital appreciation, and just growing a certain amount of savings, passive income or cash flow, whether they want to have just quarterly checks or monthly checks that are kind of sent to them to offset income. Some investors have strategies specifically built around tax benefits, tax deductions, depreciation, write-offs to either offset other gains that they have or to offset income on a W-2 or from their job and stuff like that. The other parts are diversification, where if you've got a lot of your assets into the traditional markets, which you probably should, diversification and blending a little bit of that into real estate is also something we see a lot. And also, something that's been popular the last few years is kind of an inflation hedge, with the markets, general markets going up and down, in a volatile way at times. Real estate can help stabilize that a bit. And we're going to dig into the tax benefit side of it. So when you look at IRAs, there's the general concept of IRAs. There's a lot of different ways you can go. It's very confusing at times to people that are looking at it for the first time. But just to kind of really touch on it broadly, you've got your traditional IRAs and your Roth, which are your primary, and those are usually starting points for many investors to roll over into or to shift over into self-directed IRAs. You have access to stocks, bonds, your traditional Vanguard, Fidelity, mutual funds, ETFs, that sort of thing. SEP IRA is for self-employed and small business owners, very similar to a Roth or traditional, but with different limits for self-employed based off of revenue and whatnot. Simple IRAs, which are more for smaller businesses with under 100 employees, same kind of market, stocks and bonds. Traditional mass market investments. Then you've got your rollover IRAs from 401ks, the self-directed IRA that we'll talk about today. And, there's always a lot of different variations on these sort of items. You got backdoor IRAs, there's mega backdoor, there's a lot of different ways you can go. But just notice a typo in the corner over there. But we're going to dig into self-directed IRAs. So what is a self-directed IRA? To start on the basic level, it's taking a traditional Roth or a traditional IRA and opening up a new account in where you allocate a certain percentage of your traditional or Roth IRA to investments that are alternative investments, essentially different from your Vanguard account, your Fidelity, your Schwab, you name it. And with alternative investments, you get access to different things that you normally wouldn't see in the market. You can get access to cryptocurrency investments, like Bitcoin, Ethereum, precious metals, real estate, which is our specialty, startups, hedge funds, venture capital. You can do for currency trades. There's a lot of different things you can get into. And self-directed IRAs in general give you a little bit more control over your investments. My general advice with everything is, keeping a good allocation of your portfolio in your more traditional assets, and then blending and, investing in other items to help blend and diversify your portfolio a bit. So the way it works is pretty straightforward. Once it can be confusing at times when you really kind of look at it at first, but once you get into it, it's pretty straightforward. With the self-directed IRA, once you find an asset or an investment that you're looking to do, you can contact or you touch base with your custodian or a third-party administrator who helps you to navigate the paperwork, and you can invest in the investment that you choose through the third-party administrator into the investment. And then basically that's it. So basically what happens is any funds that go from your traditional IRA or your Roth go directly to the third party administrator. They act as the manager or the intermediary, and they help you vet the investment and provide the documentation that's needed. So your money goes from your Roth to the third party, or actually it can go from your Roth directly to the investment via this third party administrator. So what happens is the the IRA maintains its separate, an arm's length distance from you, so there's no self-dealing. At the end of an investment, what happens is the money goes back from the item that you invested in, back through the third party, back right into your IRA. So you have $10 you invested in whatever asset you want to be, whether it's Bitcoin, real estate, or a company. Let's say you make $25 on that investment. That $25 then goes right back to the traditional or Roth IRA, leaving it untaxed and with a full gain. It has to stay in that trajectory of going from the IRA to the third-party administrator to the investment and back the same way in order to maintain and follow IRA compliance. So that's the quick version of what it is. As far as eligibility, setup, and cost, it's pretty straightforward. W-2 earners, you have to have a setup, a traditional, Roth or IRAs. Age cap 73, U.S. citizens, legal residents with earned income. That's kind of the basic for who qualifies. And, the part that comes up a lot, I think, with investors in general is, picking custodian. And we'll dig into that towards the end, and I'll give you some examples. But you have to pick an IRS-approved custodian. It's not a traditional brokerage firm. It's really a bit of a specialty. And you look into what kind of options and kind of communications and, the reputation of the firm. I think that's really the big key is kind of finding a firm that you think is reputable and you feel comfortable working with to manage your money, essentially. And then the process to fund the account. You're rolling it over, like I said, from other IRAs. You can do a direct transfers. You could do a new one. New contributions, if you're starting a new one, is about for 2025, it's 7,000 or 8,000 if you're over 50. And then from there, it's really, there's another way you could do it where you could set up an LLC or a trust for the self-directed IRA where it's called, where you have more checkbook control, where you essentially have a checkbook and you manage the investments. It opens you up to a little more scrutiny as far as you have to really know what you're doing. Otherwise, you might fall out of compliance with IRA, regulations. So that's something just to look at. And then, again, you identify the assets you want to invest in, like we were saying, real estate, private equity, syndications, or any other alternative investments. And, the custodian helps you, facilitate the transaction, make sure you're in compliance. The custodians in general, they charge a few $100s for the transaction. I would say usually it's around $200 to $500 to set up your more general SDIRA. Checkbook IRAs or where you have an LLC or trust maybe can cost a little bit more, but overall that's the general parameters of it. Self-directeds are, from the investors that we've worked with, if it's a variety of people. It's self-employed individuals, high net worth investors, high salary individuals, longer term investors, or those just looking for something to blend or diversify their portfolio, or you're looking for something alternative than the traditional, Vanguard S&P 500 fund. You're looking to kind of just diversify and hedge your investments a bit. But it's suited for a lot of people, and I think the hardest part is really just getting an understanding of how it works. As we get into this a bit, we'll kind of talk about some case studies and give you some examples. And this one is kind of my favorite. This is kind of news that kind of was in the media a few years ago. It's kind of caught up again. But I think it's just the best example of how an SDIRA works. So Peter Thiel, he's a famous venture capital investor, PayPal founder. Politics and all other social media stuff aside, I'm looking at this just straight from an investment perspective. So what he did was he essentially used his Roth IRA and bought his shares for his first investment with PayPal through his SDIRA. And then when it came to sell PayPal and then roll his investments over, at the end of the day, he kind of essentially walked away with $5 billion tax free because he used the self-directed IRA to its full potential. I think it's really kind of the best example of someone at a high or a larger scale doing something that is available to everyone really. So I always like to bring it up a lot. I'm going to dig into it a little bit more because I like kind of playing with the concept of it and how it applies to everyone. The other thing about this is, like I was saying, in '99, he put, 1,700 into PayPal through his Roth. And then he went through a series of transactions with, various investments. He went from 1,700 with PayPal, then he invested in eBay in 2002, and then that 1,700 became 28 million. In 24, he invested 500,000 again in Facebook, sold that in 2012 for $1 billion. And it's estimated now that, or from the last time, they had run some numbers on this, it was around in 2019, it was about $5 billion was the ultimate value of this chain of investments that he did through his self-directed IRA. One of the things I liked to do, and I kind of extrapolated a bit and had some fun with this, just for the sake of conversation today, was, the analysis on Thiel and what he did with his self-directed IRA ends as far as, popular meter in 2019. But if you take the investments that he did from 2019 to 2025, there's a handful of big firms and big winners essentially on the VC side. Lyft, Palantir, Stripe, SpaceX, Airbnb. Those are the big five. There's a bunch others, but to me, and there's no reason why he would have taken the $5 billion he had in 2019 through his SDIRA or as an IRA and not do the same exact thing with these new investments. He was doing that essentially for 20 years. So my assumption is that he did the same in the last 5-6 years. So if you extrapolate that and you take the value of these new entities and these new investments, today's estimate, kind of midway, a moderate estimate is around 19 billion is what the value is of his portfolio. And if we were to look at it as his self-directed IRA. So again, from $1,700 in 1999 to today, it could be worth around 19 billion, all tax-free. A lot of people will say, upfront, oh, it's a scam, it's fraud, it's a little bit of luck, fancy lawyers, fancy accountants. But when you look at this at the most basic form of what he's doing, it's a self-directed IRA. He's taking money from his Roth IRA, investing it in an asset, taking the gain from that asset, rolling it back to his self-directed IRA, and then doing it again over and over and over again. I think that's just a really nice example to kind of show how this really can kind of balloon and go. So also, I wanted to do like a bit of a case study to kind of look how it applies to real estate. Taking a similar concept with a $50,000 investment, over a 4-year cycle. For the ease of discussion for today, I assume an 18% annual return, and each one of these investments is a 3-year term, all done via your self-directed IRA, where you roll 50,000 into an investment, it becomes, for the sake of this conversation, 82,000. After the first investment, it goes back to your self-directed IRA, then into investment number 2. It comes out of and it kind of goes through this pathway for 4 cycles, and essentially you're taking 50,000 and you're making it 221,000 tax-free over the course of a 12-year investment cycle. Granted, I used 18% just as a round number. If everything goes great and you get 18% every year for 12 years, that's fantastic. Life and markets are a little more volatile, but I think for the sake of the discussion, I think it really kind of show you that just on a general basis with your everyday investor, these things really can be quite effective. It gives you greater control over your investments in general. To me, it's easy to manage once you get the general setup done. It allows you to like we were saying earlier, diversify your portfolio a bit. And you can blend alternatives, regardless of what you choose, the investment, whether you're investing in, if it's real estate, if it's self-storage, industrial, office, retail, multifamily, you could choose a lot of different things. You can go with many different sponsors. It gives you a lot of flexibility to pick, or if you want to work in certain jurisdictions or parts of the country, whether you want to stay in the Northeast, West Coast, you want to stay down in Texas, you want to go in Florida, you have some options where you can really kind of fine tune your personal investment choice, and that's why I like it. It's funny, as I've kind of gone through this process over the last couple of years of really starting to understand how these work, and working with other investors, I've started to do it. I've it's one of those things like it's kind of hard to resist, where it makes a lot of sense, for people that are, at a variety of different phases in their investment career, whether you're just starting out, whether you've got kids that are going to college, you're looking to retire, it can help a lot of different people in different ways. So I've become a big fan of it. So yeah, so now taking that same sample with real estate, just to bring in like a real life example, this is a deal that we did in Williamsburg, Brooklyn, a few years ago. I think we finished in 22 or 23 for this project, but again, it was like a 2-year deal, where we bought an asset. And this is kind of traditional of like the kind of work that we'll do in like these kind of small syndicated portfolios. We'll buy 2 or 3 of these smaller assets, retrofit them, convert them from a 1 to a 3 family to a 7 or 8, lease them out, stabilize them, and sell them as a finished building or as condominiums. In this case, it was a rental building. Worked really well. Came out of COVID when rental prices were going up, so we had a nice ROI on this deal. But this is the kind of thing where it's a smaller investor for us, like with the investors that we work with. We have a small group of syndicated investors that come into a deal. Everyone has, can invest with, there's SDIRA or a variety of different ways. But I think it's a nice way to show the progress and, in how you can really do it. The key rules and the risks with SDIRA IRAs are, something to always kind of, keep in the back of your head and just make sure you understand. A custodian or your third-party administrator will help with this a lot. And a lot of this information, or all this information, is available online. So depending on how sophisticated you are on the investment side, you can really kind of dig into this. And you just have to, there's not too many rules, but there are some, and you have to pay attention. You want to, if you break some of the IRS regulations or restrictions that they have on SDIRAs or Roth or traditional IRAs in general, it triggers the penalties and taxes. And so you just have to be understanding. A big one that kind of comes up is self-dealing, and what can disqualify you as or an investment as an IRA investment. And basically, you can't self-deal. You can't buy a personal residence or your vacation home with a self-directed IRA. You can't do business with yourself directly, or the beneficiaries of your IRA. You can't do deals with or arrangements with your spouse, your parents. I like the detail they go into a bit with grandparents, great-grandparents, children, spouses, grandchildren, great-grandchildren, and their spouses. It goes on and on. So basically, any family dealing is considered self-dealing and would trigger a penalty by the IRS. With self-directed IRAs, custodians can help you how to set it up, make sure you're in compliance with the IRS, but they're not really going to give you advice on what deals you should do. That's something I think every investor should look at directly, to make sure you're working with the right groups or the right type of investments. The big thing I always kind of suggest with investors with that is, become an accredited investor, just become more knowledgeable, understanding how offerings are set up, what you're looking at, what fees are being charged by the sponsor, regardless of what it is, and just have a good understanding of it. Liquidity is a big one. Unlike stocks and bonds, real estate or some other assets or alternative investments that when your money's in there, it's going to be in there for the term, whether it's a 2 or 3 year investment term, that's how long it's going to be in there. So you have to be prepared for that. And, the SEC's take on SDRAs is that, because the custodians don't provide financial advice because they can't really. You just have to be careful, and you have to be wary of fraud, making doing your own due diligence, and vetting investments thoroughly, vetting sponsors. Well, I'm sure we'll do a whole webinar series. We could do it just on how to vet sponsors and different investments, but that's some conversation for another time. But these are the main things to really kind of to look at when you're looking at the risk and concerns. There's others, but these are the kind of the main that kind of will stick out. So now what? We went through the basics, and I tried to kind of get into as much detail for a short webinar to kind of give you an overall picture of it. But it really comes down to 4 steps. You decide on the investment, what you want to invest in. Step 2, you select the custodian and you complete their applications. We have a list here of 5 third-party custodial firms. I have no affiliation. Mortar Group has no affiliation with any of these. We're not compensated by any of them. Some of these groups have been used by other investors that have come to us. But you have Trust Group, SDIRA, Equity Trust Company, Madison Trust Company, and Strata Trust. Those are kind of the bigger ones that kind of tend to pop up quite often with some of our investors. But again, just do your own research, find a company that you're comfortable with. There's also local companies, depending on where you're investing in the country or where you live in the country. There's local shops that can help you as well. These are some of the bigger, more national. But that's step 2. Really pick your custodian and complete their applications. Pay their $200 to $300 or $300 to $500 setup fee. Then you fund the account. You transfer the money from your Roth or your traditional IRA to the self-directed IRA investment. Get verification that it was funded. You execute your investment docs as needed, and then that's it. You're done. At that point, you manage this investment like you would any other. And then at the exit, once you are paid back out, that money goes right back to the third party, through the third party and the custodian, back into your IRA. Again, all tax-free, and that really, it's a full circular process. So I think it works pretty well, and I think that gives it a good quick summary. There's another fun fact that I thought of last night, was that after you extrapolate out his gains from 2019 to 25, and you estimated from, let's say, 17 to 24 billion dollars, and you pick 19 as kind of the middle number. He's 58 this year, and it brings up an important point with self-directed IRAs. Once you turn 59 and a half, you have unlimited access to your IRA savings. To do basically with whatever you want. You could withdraw it, you could spend it, it's yours after 59 and a half. So that plays a lot into people's investment strategies and how they're looking to utilize self-directed IRAs or more traditional IRAs. Once you get past 59 and a half, if you don't want to use the money, there's a lot of other ways you can go with it. There's trust setups, there's estate planning, there's so many different avenues you can go to continue saving. You can continue to use your IRA afterwards. But if you're looking for more generational wealth and accountability, that this is a vehicle that people can use after that, where they set it up into a trust and kind of pass things on in more of a estate planning type way. So there's a lot of different ways you can go about it with that. So that is it. That's a quick summary. Again, I know we ran through it a bit quickly, but there's a lot of information, and I wanted to kind of touch on a little bit of all of it. If you're interested and you want a copy of this presentation, just shoot us an email, give us a call. You could reach out to Francesca or Harmeet as well, and they can answer any of your questions. If anyone has any questions, happy to dig into any now. Yeah. sometimes, the big questions that usually come up with investors, and I've referred to this earlier, is who to use for your custodian. I think that's the big one. Um, I think there's a few shops. When we first had investors starting to come into this in, let's say, 2018 to 2020, it was less of a digital footprint. There was less information on it online. Now there's a ton, and you could really kind of see the bigger shops, and you can talk to different people and get a good sense. The five that I mentioned seem fine. We have investors that seem happy with them. But that's usually the big question. And then how do you set it up? You know, so I think, I think it's a really interesting tool, but once you get into it and understand it, it's really straightforward. And I've seen some investors really have fun with it, with the idea that they're really utilizing it well. They're maximizing it to kind of offset their own kind of income, where they're trying to put more, and they're just building this Roth IRA over the course of a 10 to 20 year span. And it's just kind of continual growth, which I find really interesting. So yeah, that's usually the big questions that come up. Other question is about getting a replay. Yes, we'll post. We'll email everyone that's signed up for the webinar a copy of this recording as well. And if anyone wants a copy of the presentation, we can give you that as well. That's not a problem. Another question was a recommendation about using IRA Financial. No particular recommendation. I've heard of them. Again, I would say there's probably 5 to 10 big shops that kind of pop out. It's a lot of them are good. It's just doing your research. There's a lot of recommendations, a lot of reviews that you can find online. Reddit is always kind of my go-to. Some of the forums. It's kind of like with recent discussions I had with investors. Forums are a good place to look for information on investments, sponsors, and for SDIRAs. If you're familiar with Bogleheads and that whole network of investing ideology, that's a really good place to go and dig into those forums. You could spend hours kind of looking into that stuff. But overall, I think the top 5 to 10 shops are pretty good. I don't see any issue with them so far. But yeah, that's about it. So yeah, no, I hope this was helpful. I hope it helped to answer some questions, to help you give some direction on if it's an option for you. Like I said, it'll be available. If you have any questions, reach out to the team here at Mortar. Reach out to me. Happy to discuss it over the phone, go into detail. I find it a really interesting topic, so it's easy for me to dig into it. But yeah, I hope you found it helpful, and thanks again for listening. Have a good day.